Now let's get right to Barry Martin, CFA, Portfolio Manager, Shelton Capital Management's Option Overlay Strategies. Barry, so tell us what you're thinking here when you talk about investors that they need to proceed with caution. Use the phrase income investors. What does that mean exactly?
Yeah, I mean, as you know, well, first of all, thanks, Nicole, for having us on. With the Fed raising or likely raising interest rates, what that's going to happen is basically raise volatility. So as volatility increases, what do you do with that for investors? What we do is we sell it. And by selling that vol, we generate additional cash returns by monetizing that vol. So we're generating additional income, which helps clients down the line. But it also reduces volatility in the portfolio.
So it's making money, basically.
Exactly.
That's what you're telling me. By investing in volatility, people can make money, right? That's what you're calling an income investor. You know, it's just so funny because, you know, I think that all investors want to make money. And I do like what you're talking about with the elevated VIX, and you have potentially the ability to take advantage of those markets up and down, and you're using options as well. Tell us a little bit more about it.
Well, what we do is we sell covered calls on large quality names. And so you know, when you're selling covered calls, it does a couple things. One, it reduces the beta, and it also reduces the standard deviation. Our current beta is about 0.76, and our standard deviation is 13.84, which is both lower than the market. But what we're also doing is generating yield. Right now, our yield, according to Morningstar, is north of 9%. So when clients are looking at their portfolio and looking at a fixed income portfolio and searching for yields, this type of product, covered call writing, seems to make a lot of sense. I mean, typically, historically, people have used a 60-40 portfolio. If you let that sit over the last 5 years, that 60% has pretty much risen up to close to 80%. What we're recommending is taking a portion of your equity exposure and your fixed income exposure and creating a new slice of the pie for this derivative income strategy.
Right. Yeah, the EQTIX is the 5-star fund you're talking about here, right?
Correct, exactly.
And so the way to do this is how?
Yeah, so you can buy it pretty much anywhere, especially on the TD Ameritrade platform. But basically, it's a fund of roughly about 80 to 90 equities with individual covered calls written against it. And so what the individual covered calls, what they do is basically, if you want to own Apple, so we buy Apple around 160, and then we sell someone the right, but not the obligation, to purchase Apple off of us at a predetermined price. And so in that case, typically we're selling options that are 8 to 10% out of the money. So someone's going to give us money for that right to buy Apple off of us in the future at a higher price. And with that money, we put it in our pocket and distribute it. Now, come expiration, if let's say we sold the March options, we have a decision to make. If Apple is above that certain strike price, we can buy the option back and sell another one. Or if it's below it, we'll likely let the option expire and sell another one. And so we continue this process throughout the year. So we do very well in choppy sideways markets with elevated volatility, basically like we're seeing now.
Yeah.
You know, the higher the vol, the more we can receive for selling these covered calls.
Sure. Understood. Barry, good to see you. Barry Martin, Shelton Capital Management, right? Taking advantage of these market moves that we've been seeing in a big way. Barry, thank you very, very much.
Thank you. Take care.